Good morning. Good morning, everyone. Welcome to another earnings call for Sygnus Credit Investments. My name is Haughton Richards. I'm Investment Management Associate at Sygnus Capital Limited, which is the investment manager for Sygnus Credit Investments. Today, I'll be joined by Jason Morris, who is the co-founder and CIO for Sygnus Capital Investments. And today, we're going to be discussing our June 2022 financial results. I encourage you guys to get a copy of the MD&A that was released to the JSE on Monday, along with the audited financials as we walk through this. We're going to give it about 5 minutes or less, just so everybody can join, so we can have a thorough walkthrough and discussion. We will have a walkthrough of our Q&A. We'll have a Q&A section towards the end, at which point in time we'll open the floor to questions. You can send your question throughout the presentation as well, and we will adjust it towards the end. And again, I just encourage you guys to read or have a copy of the MD&A open with you as we walk through the presentation. All right, morning again, everyone. 10:03, so we'll start. So again, just a good morning to everyone. Welcome to Sygnus Credit Investments earnings call pertaining to our recently released audited financial statements for the June 2020 financial year. We will be walking through just key highlights of some of the discussion that would have been highlighted further or more detail in the MD&A. So I encourage everyone to read the MD&A along with the presentation today. We'll be joined by Jason Morris, our CIO and co-founder of Sygnus Capital Investments, who is the investment manager for Sygnus Credit Investments. And again, we will have a Q&A session towards the end. So we advise that you send your questions throughout, and we will be addressing them towards the end. As you see on your screen, I also want to give notice that we'll be having a Sygnus Day that will be on September 22nd, 2022. More information will be released to the press, but you can save the date from now and you'll see more as we go through the presentation. Jason, are you here with us?
Yes, I'm here.
Go ahead.
Good morning, everyone. Just a few corrections. I'm not actually CIO of Sygnus Capital Investments, actually Sygnus Capital Group, and the financials that we'll be discussing is for the year ended June 2022, not 2020. Okay, so let's move to slide 4. So good morning again, everyone. I'm happy to have you. So let's start off with some key milestones. So Sygnus Credit Investments Limited at the end of June 30, 2022, effectively would have been operating for 5 full years. So started on July 1, 2017. So we just want to highlight some achievements, not over the 5 years, but during the 5th year of operations, which was always kind of a target year to get to a particular base level from which the company can then be scaled to greater heights. So the first thing I would want to highlight here is that the company would have expanded regionally by doing an acquisition in Puerto Rico, which would have been discussed in prior quarters, and there were also press releases about this. So effectively, we did this to diversify the revenue base of the business, as well as to allow the business to scale significantly, given the size of the Caribbean territories that SCI had exposure to. If you add all of their GDPs together, you won't get the GDP of Puerto Rico, which is $100 billion US territory. So that acquisition was a $22 million transaction. So that's the first thing I want to highlight as a key 5th year of operation milestone. Second thing is in terms of growth in the business. The target was to get to $8 million US in revenues by prior to December 2023, and would have hit 8.25 million in core revenues a year plus earlier than targeted. So that's a good thing. The business does not have a growth problem. Third thing, I'd like to highlight is scaling the business, which is, I'm a startup 5 years ago. It grows from year 1 to year 2 to year 3, but then you need to scale it, which means can you get a big jump from one level in terms of scale to another level and then start a new growth path. And that target was to get to pretty much 100 million USD in private credit investments across the Caribbean region and have a balance sheet at or thereabouts 100 million as well. And we're happy to report that the balance sheet of SCI is now 137 million. And the overall portfolio of private credit investments, including the acquisition, is north of 100 million. So all of this would have also been achieved a year plus earlier than targeted. Fourth thing is in terms of dividends, the objective was always to grow dividends and get to a threshold level where we are, within a 5 to 7% yield level. We're not quite at this 7% yield level yet, but certainly in year 5, we are on track in terms of where we expected us to be. We delivered the highest dividend distribution paid during the financial year of $3.1 million. So that's another key milestone that would have been achieved in the 5th year of operation. And last but by no means least, to achieve the scale that we were speaking about before and to get the growth and to do the expansion, you have to finance it, right? And we started out by depending heavily on equity financing through an IPO, and then in December 2020 / January 2021, doing an additional public offering. So beyond that, we started to utilize debt, and this financial year would have raised over 50 million US dollars equivalent in debt financing, both in terms of rolling existing debt as well as raising new debt capital, which is what was used to grow the business in terms of growth and scale. So effectively what we have is the business has a very solid base, a solid foundation laid over a period of 5 years. And going forward, the expectation is now to focus, take all of that solid foundation and grow earnings per share, grow return on average equity, execute the share buyback, which I'll discuss a little bit more later. But this is not really new news. It was in the prospectus and actually offering memorandum and prospectus for the IPO and private placement, etc. And also the APO, in terms of once 5 years after being listed on the stock exchange, we would offer to buy back up to 15% of the company. So that's not new news. It's just the details around the precise structure of that buyback, etc., that we are still working on, and it gives them more information on that. So all of those things combined, we want to do to effectively enhance value for shareholders by driving share price appreciation. So I want to start out with that, given the company, has completed its 5th year of operation. Now into the performance for the financial year. SCI generated record total investment income of 8.25 million, up 27.1% versus the previous year. And included in that total investment income would be the first signs of the revenue diversification from the Accrescent acquisition. And just to highlight, as we'll do throughout the rest of the presentation, AFC, as it's called, our Puerto Rico Credit Fund, is not consolidated all the way up into SCI, and I'll explain that a little bit more. In terms of net investment income, that was a record 5.27 million, up 40.1%. Net profit, down 24% to 3.82 million. And the primary reason why net profit was not also a record is due to a charge-off. Well, two things. Primary driver is due to a charge-off of 3.85 million relating to one portfolio company in the Cayman Islands, which I'll delve into a little bit later, as well as some upfront accounting FX losses of 307,000 US dollars. So, we were really pushing to get that record number, but these events occurred and kind of put weight to that a little bit. Earnings per share, 0.65 US cents versus 1.11 US cents previous financial year. And dividends paid, as discussed previously, 3.1 million, a record, up 77.9%. On the topic of dividend, the board of directors will meet on Friday, September 2nd, 2022 to consider an interim dividend payment. Next. So the next slide shows you the trajectory of core revenues and core earnings, which are very important. These are the drivers of SCI's ability to sustain dividend payments. Also, to show the health of the company in terms of growth, which is very important for every company. So since inception, core top line revenues, our core revenues has been growing at a compounded annual growth rate of 47.2%. And we expect this to continue beyond the 5-year period just discussed. This is a summary of the results of operations, and I kind of went through the base numbers already. Just want to highlight maybe two or three things here. If you look at the line item that says Puerto Rico Credit Fund investment income, this line item, if you look at the audited financial statements itself, you're not going to see this line item per se. So the Puerto Rico Credit Fund investment income is effectively rolled up in the overall fair value that is reported in the audited financial statements. But for the purposes of allowing shareholders to understand the financials a bit better, we have broken out the Puerto Rico Credit Fund investment income. And that is important because the acquisition was done utilizing debt financing. And so what that means is that interest expense on that debt that was used to finance the acquisition would have gone up, meaning interest income versus interest expense, that difference, if you look at this year versus last year, you would see where the number is even though it hasn't grown by a lot, and that's because of the interest expense and the debt that's used to fund the Puerto Rico Credit Fund transaction, but there is no resultant interest income coming in from the Puerto Rico Credit Fund investment or the acquisition of Accrescent, because it's not consolidated all the way up in the SCI. So this line item reflects the value created from the Puerto Rico acquisition, which effectively reflects the book value of the transaction with an adjusted multiple. And the change in that valuation effectively gives you the change in fair value, which flows through the income statement. The second item I would like to highlight is the net foreign exchange gain. You would see that it's 405,000. Well, next foreign exchange loss, which is 405.2 thousand, and I said before 307.8 thousand of that is not actual crystallized or realized losses. It's basically an accounting loss relating to index notes that were used to finance the balance sheet, meaning SCI raised debt using index notes, and we have to take an upfront charge, which is the difference between the 10-day moving average rate that is used to price the index note and effectively the rate of exchange on the particular day. So it's effectively a paper loss. And the third item is the Imp Payment Allowance, which went up significantly. And this is really in relation to one investment company, Cayman Islands, where we took a charge off of 3.85 million. I'll delve into that a little bit later when we go through some risk slides. But overall, this charge off translates, it's the first charge off that SCI would have had during the 5 years of operation. And it, in effect, over the 5 years of operations, would have deployed over 220 million in investments. So the charge-off is effectively an annualized loss rate of 0.3%, which is very low by international standards. Moving on to how the company is being run in terms of its efficiently. Are we wasteful with shareholder dollars, or are we managing a tight ship? So there are two key metrics to this. Efficiency ratio, which is measured as total investment, total operating expenses to total investment income. And you will see that for the financial year, that would have come in at 36.1%, which is within the target threshold of 40%. And you notice that every year since operations, we would have come in within this target, save and except for last year, when the company made record profits and would have paid its first performance fee for generating those record profits. And the management expense ratio, which is pretty much looking at the operating expenses relative to the assets under management, again, another key metric to determine if we are being wasteful from a operating expenses perspective. That would have come in at 2.2%, well within the target threshold of 2.85%. That was promised to shareholders in the private placement, in the IPO, and in the APO, and that will remain a threshold that we will always endeavor to operate the business below. Again, the reason why we came in above that threshold last year was because of the aforementioned performance fees for those record-breaking profits. On the balance sheet, shareholders' equity stands at 67.46 million, up 1.1%. Total assets stands at a record 136.79 million, up 55.7%. Of course, that would have been driven by the record amount of debt financing that was raised during the year. And this includes the valuation on the balance sheet of 24.16 million of the Puerto Rico Credit Fund investment, which represents the Accrescent Financial Corporation acquisition, which is not fully consolidated all the way to SCI. In terms of balance sheet KPIs, SCI is a very conservative balance sheet business, and the reason why the company is operated that way is so that whether you have good times or bad times in terms of economic performance across the various Caribbean territories that SCI has exposure to, the company will be able to withstand severe shocks. So debt to total assets ratio, the limit there is to remain below 0.5 times. And as you can see, we were at 0.47 times, up from 0.22 times last year. And the very low levels last year was because we raised substantial amounts of additional equity via the APO in early January 2021. So, we pretty much didn't have any debt at that time. Asset coverage ratio, target threshold to be greater than 1.5 in keeping with international best practice for private credit investment companies. And we are at 2 times. Debt to equity, 0.96 times, so below 1. The limit on this that we have is to be below 2 times, and management sweet spot is to be at around 1.25 times. Of course, management target debt to equity ratio can change depending on the strategy in the business, but for now we are managing just to get to that 1.25 sweet spot. And overall, the balance sheet has 100% pure financial assets, which is not a KPI, but it's important because it gives the company very high flexibility in terms of converting those assets easily to cash if there was ever a need or desire to do so. So effectively, you can see that SCI can take on additional debt, deliver the business, and enhance shareholder returns once the returns being generated from using that debt capital gives us the optimum bang for the buck. Next. So now moving into the portfolio activity for a financial year. The investment in portfolio companies at the SCI level, excluding the value of the acquisition and excluding the assets of Accrescent Financial Corporation was 98.35 million at the end of the year. We actually exited 8 million of investments 6 days prior to the end of the financial year. So this number would have been, above the 100 million threshold were it not for that. Be that as it may, if you look at the overall exposure to private credit investment is 122.51 million when you include the carrying value of the Puerto Rico Credit Fund, which is the acquisition for Accrescent. In terms of portfolio company investments, we have 30 versus 31, primarily because we exited 3 portfolio investments valued at 11.7 million USD during the financial year. New investment commitments, 28 million versus 41 million last year. But if you included capital that was deployed into Accrescent's acquisition, that's 49.22 million in new investments in the year. Fair value yield, 13.3% versus 12.7% last year. Of course, interest rates are rising and SCI is benefiting from those rising interest rates on the asset side. Tenor, 1.8 years versus 2.1 last year. So very low duration risk. And dry powder on the balance sheet, 8.47 million. And 8 million of that, of course, is due to the exit that occurred 6 days prior to the end of the financial year. In terms of dry powder, we also had access to 3.4 million in undrawn credit facilities, plus the remaining balance from a 14.7 million pref share that was launched just prior to the end of the financial year. So there's that capital to come in to add to dry powder. To add to dry powder as well, we are in negotiations with international financing partners for a substantial credit line, and you'll understand the size of those credit lines. If you look at the pipeline, we had 20 million in transactions awaiting in approved transactions awaiting documentation and drawdown, but the total pipeline is well in excess of $100 million across the Dutch and English and Dutch speaking Caribbean territories. So this does not include the pipeline for that Accrescent Financial Corporation has in that separate business. Next. So in terms of, this information is not contained in the financial statements. This is just giving you some insight into Accrescent Financial Corporation. At the end of the financial year, it would have 74.33 million in earning assets on the balance sheet. Overall, it has 151 million in assets under administration. The difference being assets held, being serviced off balance sheet, where they might represent co-investor transactions or assets that were booked on the balance sheet and then sold and realized upfront income. And now we charge as well at small fees being paid by those external parties to administer those assets. These assets, the portfolio business has 2 segments. It's comprised of what you call structured credit, which is the same thing like what SCI does, and you also have gross credit, which effectively are financial leases, to companies in Puerto Rico. Of course, Accrescent is a company with a 19-year history. It has a loss rate less than 0.2%. Very, very, very low by any measure that you want to look at it. Operating in $100 billion US territory in an economy that was actually, faced difficult times for more than a decade. It has emerged from those difficult times now, though. So I guess SCI has kind of perfect timing with this acquisition. During the first 6 months from January to June, the business would have had new investment commitments north of 30 million. I won't say exactly the amount, north of 30 million US dollars, which is the highest on record. And these transactions would have included what you call true sales, which generate upfront gains. So you pretty much structure the transaction and sell them off the balance sheet and recognize the income upfront. And also part of some of those assets would actually be held on the balance sheet to generate net interest income. In terms of yield, just a tad above 10%. So it's operating in a effectively an extension of the US economy. So the yields that are generated in that neck of the woods is going to be lower. And as well, the cost of funding in that neck of the woods is also lower than what it is for the Caribbean, which has, in general, a lower credit rating. Tenor of these transactions on the balance sheet are shade under 3 years. So it's a little bit longer than SCI's average life. Risk management, proactive risk management. Non-performing investment ratio came in at 2.3% versus 2.8% last year. This 2.3% though exclude the charge-off, which I explain in a little while. The target threshold is to maintain no greater than 5% in non-performing investment ratio. So that's how we know if we are really managing the operations of the business properly. We actually have remaining on the balance sheet 2 stage 3 assets, excluding the one asset that I'm referring to as a charge-off. So going now to the one asset that was was put on stage 3, I think in Q1 September 2021, we would have made a provision of 561,000 on this asset in Q3 March 2022, and based on our current evaluation of the asset, we have decided to take a full charge off of 3.85 million of this asset, which include 3.4 million in principal and the remaining in interest to get you up to 3.85 million, which translates to an annualized loss rate of 0.3%. This being the first time that SCI will be taking a charge off. And as said before, this results in an annualized loss rate of 0.3%. In other words, if you look at all the charge-offs that we have done since inception, this is the first one, and our 5 years deploying 220 million, that's at 0.3% annual loss rate. All the remaining assets, so we have two stage 3 assets amounting to 2.33 million. One of those stage 3 assets is a company that actually was declared bankrupt, but based on the sale of the asset by the receiver, SCI, based at the last meeting that we would have attended in I think August, SCI will get repaid its monies in full. We actually have additional collateral outside of that anyway, so we expect to get fully repaid on that. On the Cayman asset, just to back up a bit, on the Cayman asset itself, which is different from that 1 million asset that I'm speaking about, that was declared bankrupt. On the Cayman asset, obviously, we are pursuing all channels to recover our investment in part, or if possible in full. There are some important court dates coming up in September. There was a court date scheduled in August, but an extension was granted until the 16th of September. So we will see what comes of that. The sponsors, yeah, let me not say anything more on that. So it's not that we're not pursuing our channels to recoup the investment, but we have decided to take this charge off because of our expectation in terms of probability of recouping our investment. Of course, we'll continue to explore our channels to try and recover that in part or in full. In terms of portfolio allocation by industry, so on the left, we have what the portfolio allocation is on the 98 plus million USD that you were used to seeing before the Accrescent acquisition. So you can see that we would have had 11 industries with the largest one being 23.4% allocation to financial services, followed by infrastructure at 12.8% and manufacturing at 11.6%. Fast forward to, the Accrescent, getting the Accrescent acquisition under SCI's belt, you will see now that the portfolio, if you take the 93.66% ownership stake in Accrescent Financial Corporation and look at its 74 million portfolio and add that to the 98 million plus that SCI has, then SCI's industry exposure changes dramatically. You see that we now have exposure to 16 different industries, with new industries added because of the Puerto Rico acquisition being commercial real estate, healthcare, retail services, and wholesale trade. And of course, on a go-forward basis, we'll get access to many other industries that are simply not accessible in the English and Dutch-speaking Caribbean at scale and at the quality of the underlying assets as we can in Puerto Rico. So that's a big rationale why we would have done this acquisition. So in this instance, when you look at the overall portfolio, the financial services is 13.7%, hospitality 13%, and commercial real estate 12.5%, making up the top three industries. From a regional exposure, similar thing. If you look at SCI, excluding the exposure in Puerto Rico, you see that we would have been exposed to 8 different territories. So during the year, we would have added exposure to the USA, which is basically a holding company for a Caribbean asset that was being acquired. So Jamaica would have represented 39.3%, St. Lucia 18.7%, and the St. Eustatius, Saba, and St. Martin Dutch Caribbean Islands 13.2% exposure. Fast forward to including the Puerto Rican assets, you see that the exposure is really now expanded to 9 territories. If you exclude Dominican Republic, Mexico, Panama, and Costa Rica, because those assets are actually legacy assets that were ring-fenced during the acquisition and are being closed out. So you can see that we do get additional diversification, with Puerto Rico now representing the largest portion of the balance of the assets at 39.6%, followed by Jamaica at 24.1%. Of course, on a go-forward basis, those assets that we are closing out in Dom, Mexico, Panama, and Costa Rica, that represents future growth and expansion opportunities for the SCI group of companies when the time is right to make those steps. But the time is not now. For the next 18 months, SCI will be squarely focused on scaling the Puerto Rico driven business to become the clear number one in that market and to enhance the flow through of the value to SCI and its shareholders. Final slide in terms of update on the strategy, which we will expound on in greater detail at the upcoming annual general meeting. So there are 4 key strategic items that we have been sharing with investors, and we just continue giving an update on the strategic reset that is taking place. So with regards to the acquisition, we closed the acquisition in February. You already know that. Next target was to integrate the acquisition into SCI. We completed phase 1 of that on July 31st, 2022, as would have indicated during the March quarter, the results earnings call. And what we did there was to transfer the fixed asset and workforce into the investment manager. So this is extracting the costs that the company was carrying outside of Accrescent Financial Corporation, so that we now have a clean investment assets only type of vehicle. We have a phase 2 of the integration work to continue, which is to integrate and optimize the investment manager to deliver the optimal results for the portfolio company, which is work that will be ongoing during this current financial year, as well as to shut down the companies that any subsidiaries that Accrescent has that are going to be non-operating companies on a go forward basis. And most importantly, to scale the business, right? Raise lots of capital and deliver and execute and very, very large pipelines. And the pipeline for this business is at the moment bigger than the pipeline for SCI itself. And I would have given you an indication of what SCI's investment pipeline was on a prior chart. Second thing is to rescale and reimagine SCI's growth paths. And of course, I'll give you the updates of that at the AGM. The target was 8 million by next year, December. You can see that we would have gone through that revenue target in advance. You can see also that we're going to be looking at generating double-digit ROE and also explain the ways in which we're going to enhance earnings per share. So that's in progress. Increase annual dividends, that's an ongoing project. Increase credit line facility and availability. So we are in advanced negotiations. We would have gotten a term sheet. So we are, due diligence work is ongoing between SCI and those international financing partners. So those discussions are ongoing. Obviously, because our audited financial statements, we're doing the audit process, then that work would have slowed down a little bit until our audited financial results are completed. These are being completed. So now we will, speed up those discussions to get those facilities in place. And of course, launch new financing solutions for the English and Dutch Caribbean market. And we have actually our first deployment under one such facility that we are literally tomorrow deploying capital into. And this is, of course, separate from all the financing solutions and the work that is being done on the Puerto Rico business, which is already covered under scaling the Puerto Rico business. Third thing, strategic partnerships. We have built a ton of those with international partners and regional partners. So that's an ongoing work, as well as continuing to build the strength with institutional investors to participate in large transactions. So once we close out those credit line facilities, then we'll be able to generate real returns from those relationships. And the fourth thing, share buyback. Again, this is not new. It's not news. It's in all our documentation. We will be buying back up to 15% of the shares of the company. The exact amount has not been decided on yet. We will present this to our board of directors at a meeting later in September. And once the board makes the decision, then we'll give you all the fine details around that. Just remember that this was always in our documentation from ever since. So it's not new. It's really and truly not new information. And that's the end of my presentation. Open the lines to take calls and take your questions and have a fruitful discussion. Thank you.
All right, thank you very much for that, Jason. Very thorough walkthrough of a good amount of questions in. So I'll just go in the order which they came. So one of the first questions we received was pertaining to the preference shares. The question is, what is the status of the preference share? Was it successfully taken up during July, or has the timeline, based on the timeline indicated, and what are the amounts raised thus far between JMD and USD index?
So the pref share was extended. July, the pref share was extended because in July, there were a ton of transactions in the market which were debt focused, and of course our pref share is a bridge between debt and equity. So based on the requests from some of our investors, we extended the timeline, and we expect to close that out in another week or so. In terms of how much we have raised so far, I will have to get that number and get back to you on that. But I think we have indications of north of 10 million thereabouts at last look at the book.
Hello, Jason, you're with us?
Yes,
okay. That's
no
problem.
Yes.
Yeah, we're hearing you, man.
In terms of the amount between US and J, I'm not sure what that split is.
No
But
problem.
I think it's probably 50-50. Most investors are really looking for USD investments nowadays. So that's what I think it is.
Thanks for that. Question I got was pertaining to the winding down of the non-functional AFC subsidiaries that's to take place between phase 2 and phase 3 of the integration process. The question is, what is expected? What is the target or expected timeline in the June 2023 financial years, and what steps are being taken to mitigate against any future non-functioning subsidiaries?
Well, to answer the second question first, there won't be future non-functioning subsidiaries. Remember that is an acquisition that we did, and these businesses were started before we did the acquisition. They were not operating for some time. So now that we have done the acquisition, we're just doing cleanup, right? We don't want it. We don't want them as a distraction. It's not like they aren't actually like, you know, it's not like they have physical office space and physical incorporation per se in the various countries. It's just the actual legacy operations that we need to close out, that would have whether it be satellite operations, etc., in these various jurisdictions. So the time, so there won't be any future occurrence of that. First. Second, in terms of the timeline, a lot of this has to do with, you know, just legal work, right? And legal work normally can move slow sometimes, but we expect this to be completed certainly before the end of the financial year. But this won't impact the operations of the business in terms of generating revenues, etc. It's not like there are people who are sitting down every day focusing on this. It's just an action item for the integration team. And we have a very large integration team led by Dr. Ike Johnson, a co-founder of Sygnus, and our consultant being PwC, working on that. So, you know, we expect that to be completed within the within the financial year. Let's leave it at that, because there are some legal things that need to be settled, but it won't affect Accrescent's ability to perform and generate results.
All right, thanks for that,
Oh,
Jason.
yeah.
So additional question we got was a question pertaining to the corporate service fees. Could you state what exactly is covered in the corporate service fees and which related party is providing these services? Good
question. So Sygnus Capital Limited is a related party that provides these services, and on a corporate services fee is all the things that are dealing with hosting of board meetings, getting information out to stock exchange, hiring consultants to do various things, dealing with financial reporting, all that jazz comes up under corporate service fee, which is what the Sygnus Capital provides.
Okay, thanks for that, Jason. So a question we got was pertaining to the Accrescent acquisition for clarity. The initial JC release stated that the Puerto Rico Incorporated acquired 93.66% of Accrescent. However, the audited notes say that SCI Puerto Rico Inc. is a membership interest in Sygnus Credit Investment Puerto Rico Fund LLC, which in turn owns 100% of Accrescent Financial Corporation. Could further clarity be provided here?
Yeah, that's very simple. So in the press release, we said we use a subsidiary of SCI to do the acquisition. So that is what is being explained, the structure that was used to do the acquisition. So SCI itself, SCI didn't put the money directly into Accrescent. It used a subsidiary to do it. And that is what is explained by the notes in the financial.
Thanks for that. So an additional question that came is pertaining to the Cayman Islands asset. The Cayman Islands Resort would have had a higher credit provision in the 2021 financial notes based on the fact that it was not operating again until October 2021. Could you state the rationale pertaining to how the loan amount of 3.35 was put into stage 3 now?
Well, it was put into stage 3 from Q1 September 2021. So it wasn't put into stage 3 now. what we have done is that we have taken the full charge against the asset, because the collateral, so the asset itself, because it has been, it as we would have reported during the Q3 earnings call, a receiver was put in place. The senior lender has put the asset on the chopping block for selling. The petitioner who brought an order or was bringing an order to the courts, which would have been heard in late August to wind up the company if he wasn't paid, is intending to do so by mid-September, the new court date, unless the financing that the sponsors have indicated that they are in the process of raising is actually raised, and both the senior and junior, they told us, of which SCI is one, are paid out. Right. So based on the fact that the court date was moved from August this month to next month, and we don't have any additional concrete information about the progress of the capital that the sponsors of the company are raising, we decided to take the full charge on the asset. And then if, between now and the court date, the capital that the sponsors indicated that they are raising comes to fruition, and the senior creditors and SCI and other creditors get paid out from that refinancing, then we have an amount to write back. But we have to do the prudent thing, given that based on the valuation of the property itself and the fact that we are unsecured creditors on that transaction, which we have to do the prudent thing. I mean, we were always unsecured creditors from day one, but the collateral itself was worth almost 2.5 times what the outstanding debts to the senior lender was, right? So even our worst case scenario, pre COVID, we would have been fine. But given the fact that the asset is up for sale by the senior creditor, and the valuation on that asset is, unless you get bids that are very high, and we don't know of any such bids at the moment, and unless we get confirmation that the financing that is being pursued has been successful, then we have to take the charge. So that's what we are doing. We take the charge, and if either via asset sale there is monies to be had, or via refinancing there's monies to be had and we get back monies, then we write it back. So that is what is driving the movement.
Thanks for that. So an additional question that came in was pertaining to what is the new financing solution that has been deployed for the English Dutch speaking Caribbean?
I will never reveal that for obvious reasons, right?
Right.
Yeah, we are there are competitors and competitors, so we'll keep that close to our chest. At the appropriate time, if we think it's necessary, we'll reveal that, but we're not speaking more on that at all.
So an additional question that came in was pertaining to who is the new investment manager for Allocation Financial Corporation? Is there a particular name?
So it's gonna be a Sygnus company in Puerto Rico.
All right, thanks for that. A question pertaining to, you had made mention to the recalibration of targets from the earlier Q1. Where are we now with that recalibration of targets?
So recalibration. So obviously you don't want to recalibrate targets before you're audited. You have produced your audited financial statements, which would have been produced 48 hours ago, right? So now that the financial statements are out, then we will dust those off. Obviously, we would have presented a budget to the board of directors already, etc. But now, in terms of putting that information out to shareholders, we'll do so at the AGM. So we have pretty much completed that work, but we'll make those announcements at the AGM. So to answer your question, you could say that that recalibration is done.
All right, thanks for that. So a question that came in was pertaining to the Cayman asset. So this one says, given the charge that was booked regarding the Cayman portfolio, is if Sygnus was to enter a similar transaction, what would Sygnus do differently to mitigate a similar outcome possibly?
Good question. So if I back up a bit, so in a perverse way, you know, when we were doing road shows to investors, many people said to us, okay, how do you do your origination? Do you look at economies in the Caribbean, choose the strongest economies in the Caribbean, and then you basically you know, decide that based on the strength of this economy, I'm going to go into this and this industry, which are good industries, right? So in a perverse way, Cayman is the strongest Caribbean territory, investment grade rating, pre-COVID, the asset, you know, even prepaid us the interest that was due on the facility. Was, you know, had no issues, had very good financials. It just so happened that the COVID hit, and you know, this asset just didn't recover. Of course, Cayman's borders were locked for much longer than everybody else. So what we would do differently, for Cayman, we can't really register secondary charge on an asset, although in this case it wouldn't really matter, given the status of affairs, because even if you have primary charge on the asset, if you can't sell the asset, then you know, in the end it doesn't matter. So what we would do differently is figure out a way to structure additional downside in the case of a disaster. In this instance, to be honest, you know, we got like 1,000-year disaster where borders were completely shut, and at the time we entered the transaction, the free collateral, when you exclude the charge by the senior lender, would have been like $20 million, you know, multiple times what our exposure was. So I guess the only thing we could do is you know, simply don't enter transactions that you can't get outright protection on, or figure out a way how to structure, you know, additional, maybe get underlying guarantees. But to be honest, for this asset, you know, that would have been difficult to get it. The answer to the question would just be, in hindsight, just don't do the transaction, right? Which on the face of it, nothing was wrong with the transaction at the time we went in. So the clear answer would simply don't do a transaction like this. Because, you know, when I look back and say, could we have done something else? We probably could have tried to get some, you know, guarantees, but then if you, yeah, maybe that's the one thing we could have done. It's difficult to answer the question, to be honest. Hindsight is always 2020. And of course our track record has been, you know, very stellar in 5 years, except for this one transaction. But yeah, it simply was to just not do the transaction. Maybe because perhaps it's a hotel, and therefore in a worst case scenario, you know, a hotel can really blow up. So that's, I think, is what the solution would be. Simply don't do it.
All right, thanks for that. A very thorough answer. So one of the questions, a follow-up question to that was, we would have mentioned that there are 2 other stage 3 assets. Is there any information you could share pertaining to that?
Yeah, man, I already did. I said that one of them was declared bankrupt. We have a 1 million exposure, and the asset was put up for sale. And based on the last report from the receiver, which would have been in August, the sale price, I think a bid was accepted, and the sale price that was received is sufficient to cover our creditors. So we'll get repaid our money. We of course structured that transaction to have a collateral that was outside of the company. So even if the company wasn't able to repay us, we would have been able to pursue those collateral and get back our money. So in this instance, we are double covered and we are getting back the money from the sale of the asset anyway. And the second one is for 1.3 million, which is for a company in the mining industry, haulage and backside industry. So they have very large contracts with one of the mining companies. What would have occurred though, so we put this company in stage 3 right at the start of COVID, because in March 2020 to be exact, because at that time mining operations were closed, and so we put it in stage 3 from that time. Since that time, we have been working on a restructuring. As I said before, the company has very large mining contracts. We own the trucks that the company uses to haul backside. So that's one level of collateral that we have. We also have land to protect us. So when we went into this transaction, we were more than 100% covered from a collateral standpoint. Since that time, our last discussion with the company was they were gonna start repaying a particular amount of money every month, starting this month actually, but that has been delayed a little bit, primarily because operations at the bauxite company have been put on hold a little bit. I suspect that they'll resume operations in another month or 2 due to inventory levels being a little bit too high. So once mining operations resume, we expect the mining company to start making those monthly payments to reduce the back charges while we restructure the actual terms of the financing. And of course, we SCI was built to provide flexibility to firms. So we are not trying to kill the business. We are trying to assist the business to grow. That's our mandate anyway. So once we think that there's a sweet spot where we can get paid for the flexibility, although the asset is already on stage 3 and has good collateral cover, while assisting the firm to get back on its feet, because it has the contracts, which are very large, to haul bauxite and get paid. So that's the update on those 2 stage 3 companies. So we expect the 1 million one to be removed from stage 3. We were expecting it to be removed from stage 3 prior to now, but of course, how when you put up a company for sale, the process that the receiver needs to go through, it's a very, very lengthy process sometimes, but so far so good. So that's the update on those 2 other companies.
Thanks for that, Jason. So a question that came in was pertaining to the pipeline that was mentioned. So our the dry powder plus perfs outstanding leaves a shortfall. It is a little bit short of the $20 million pipeline. Could you indicate how it is expected to cover that shortfall that may arise? And given the larger 100 million pipeline, will we be seeing another approach to the markets? So
good question and good observation. So see that people are reading the MD&A and following on the present and the fine points on the presentation. So I mentioned the fact that we are, in advanced negotiations with our financing partners. Well, two ways. First of all, some of those transactions represent M&A financing. Matter of fact, a lot of our transactions represent M&A. Well, the ones that are approved already represent M&A transactions. And so the timeline to execute on an M&A, we sign up the term sheet, get approval, everything, all the I's dotted and T's crossed. But then the final negotiation and the final legal documentation for an M&A, can take a while. So based on our expectation for the runoff of those monies, we think we have enough time over the next month and a half or so, for one. And then two, we are in advanced negotiations to close out those credit lines that I spoke about, or to secure those credit lines that I spoke about with our international financing partners. And those lines that I'm speaking about, so if you look at the minimum size of the pipeline, that should give you an indication of the size of the credit lines that we're talking about. So we're talking about, we have right now, I think, 6.5 million in revolving credit facilities locally. But those credit facilities, which were very helpful to SCI during its very early days. I mean, it's a company that didn't have a lot of history or, a very long time in operation. So we're very grateful to those financing institutions that came on board and provided those facilities. And I think we have paid out those facilities 3 times now, I think, or 2 times, 3 years, 2 times paid out, and then redraw. But we are looking to add to these facilities, facilities from international financing institutions, which are going to be multiple times their size. So, 10, 15 times, 20 times their size. So that's where the gap will be closed, on that 20 million plus to finance the 100 million that we're talking about. And just one other point I want to add to that. I think somebody asked a question about, can we say what is the new business that we have launched? So as of right now, when you look at SCI's income statement, you notice that majority of total investment income is actually net investment income, right? Outside of the value being flowing through from Accrescent Financial Corporation. What's going to be added here in terms of revenue stream is gonna be a substantially beefing up of fee income. I can't say what quarter of the financial year this will occur, but effectively, SCI will actually have a business that it can generate fee income from it, which means obviously, it will be selling assets to get fee income. So I hope I've answered the question that was asked and provide some additional clarity to a previous question that was asked. Yeah, I don't want to say more than that for obvious reasons.
Yeah, man, understood. So some additional questions that came in were pertaining to the 17.72 million USD index note that was raised. Was that used as support for the acquisition of Accrescent?
Money is fungible, so we use all the capital that we had on the balance sheet at the time. Yeah, we use those capital to fund the acquisition. We were raising debt anyway, and we just use those debt to finance the acquisition. Right.
So a follow-up question to that was pertaining to the contingent payment. So there is an additional consideration of 2.72 to 7 million related to Accrescent. Is it that there's an additional contingent payment related to the acquisition?
Okay, good question. I forgot that point. Good observation. So remember, I think when we last earnings call or sometime before, so the acquisition works in the following way. The acquisition was structured with earnouts, right? And if you look in the audited financial statement, you'll see that there's a 2 million earnout that applies to the first year, and a 5 million earnout applies to the second year. So the way how the earnout work is that we value the company at, let's say, $1, and the management well, the owners of Accusent said, hey, this company, is valued at $3, man. So we say, okay, cool, prove it. So if you, based on these targets that you have set for yourself and that we agree to, if you hit this financial target, which involves generating a particular amount of earnings before tax, gross revenues, etc. In year one, then we pay you up to $2 million pro rata. If you exceed the target, then you get full 2 million. Likewise, for year two, which has a much, much bigger set of financial targets to hit within 1 year. If you hit these targets, if you exceed the target, then you get the full 5 million, because then the company would be valued a heck of a lot more than what the initial price paid for it, because it will. So, for example, if the target was to have $10 million in AUM and generate $3 worth of profit, but the current trajectory of the firm is to have, 2 million in AUM and generate 50 cents in profit, then clearly you can see that if the company hits that financial goal, then the valuation on the firm in terms of the flow through of dividends and value that will come through to SCI's income statement is going to be huge on a go forward, way higher than expected on a go forward basis, right? So then the earnout would be deserving. So effectively, we want them to hit those earnout targets, and we are working for those earnout targets to be achieved. So in year one, they hit the earnout target, and so, and in the audited financial statements, there would have been a value being carried of, I think, 1.9 little bit million, which the way how this was accounted for is you take the purchase price and you add to the purchase price an amount, a deferred amount, using a probability weighting at the time of the purchase. At the time of the purchase, we say, okay, we think that there's a 99% chance that they'll hit year one earnout target, which is 2 million. So if you take 99% of 2 million, you get 1.9 something million, right? They actually hit the target, 100% exceeded it. So therefore, they should be paid 2 million. And so you have an adjustment in the income statement where you see that adjustment. I don't remember what it's called in the income statement. There's a 92,000 adjustment that flows through in the audited income statement. So if you check back on and maybe if you scroll back on to the actual summary results of operations, you see where Puerto Rico credit fund investment income is showing $1.98,772, right? So that number is a combination of the value flowing through from PRCF of 1.19 million, less the 92,000 adjustment that is flowing through the income statement in the audited financial statement. So when you add those two things together, the net amount is 1.098 million. So for the second year, which started July 1 to June 30, 2023, all the expectations that we have right now, which we are operating, we are budgeting, our expectation and targets and so forth is on normal run-of-the-mill business as usual. If they hit those targets or come anywhere close to those targets, then that's going to reflect substantial upside for SCI and for shareholders. And that's what we want. So basically, there's an incentive to hit those targets because everybody wins in that situation. I hope I've not confused the person who asked the question, and I've explained it. And if there's any confusion, just re-ask the question again for clarification, and I'll try my best to give some more clarification if required.
Thanks for that, Jason. So in the interest of time, we're approaching the 1 hour 15 mark. I'll ask that for the additional questions that are still coming in, if you can direct those to the info@sygnusgroup.com.
Well, let's take a few more.
Few more? Okay.
Yeah, it is. We don't want there to be any. I mean, we have to set a cutoff time, yes, but we don't want to. If there are important questions that people want answered, we don't want to leave anyone hanging. Sometimes it's best to get the questions answered in person. So let's take a few more.
All right, no problem.
Yeah.
All right, no problem. All right. So one of the questions that came in was pertaining to in your investment notes, so that SCI Group does not control the activities of the private credit fund, and as a result is accounted for the equity investment, applying a market valuation. So the question is it that because it's a fund and will be managed by a Sygnus investment manager, is it accounted for, is that the reason why it's accounted for this way? Also, are the assets going to be measured at fair value each quarter?
Excellent observation. Excellent question. So it's being accounted for this way because there are 3 tests that need to be met for you to consolidate a company. So yes, because it's a fund and it's being managed by an investment manager, it fails 2 of the 3 tests. Yes, SCI owns 93.66%, which is majority ownership, but it fails the 3 tests as set out by the IFRS standards, and so it has to be accounted for as an investment. And so in accounting for this as an investment, clearly what's gonna happen is I guess is a bastardized version of equity accounting method, right? Because effectively what you do, you look at the book value, which obviously if the firm make more money, the book value goes up. If the firm makes less money, the book value goes down. So you look at the book value and an adjustment is made based on a control premium, because and then you apply a factor effectively to mark the company to market. And we do this by selecting similar companies, and we basically use Ernst & Young, who built the valuation model for this. So we basically look at companies that are in similar types of businesses, and look at the price to book that they are trading at, and using kind of a like 2-year daily price to book value measurement to adjust the control premium and add a discount to that. And then that's how you get this fair value for the investment. So effectively, because they're using 2 days worth of daily data of price to book for similar companies that are publicly listed, then effectively there shouldn't be a lot of volatility in that figure. So really and truly, what's gonna really and truly affect the value that's coming through is the amount of money that the company making or not making, right? If it make X million dollars, then clearly the book value gone up by X million dollars, then and that flow through based on those that valuation model. So excellent observation, but yes, that's the reason why it can't get, it won't be consolidated.
Okay. A question that came in was pertaining to, is there any additional color that could be shared in pertaining to the share buyback?
I know that this is a favorite question, so let me try to see if I can give any additional color. So the additional color, outside of the fact that we promised to buy up to 15% of the outstanding shares, which is gonna be both J-dollar and US dollar shares, obviously, is the method of the buyback, right? So when you look at how many firms do buyback, sometimes they sit and they buy back if the price drop below a certain level, or they do drip buybacks. We're not leaning towards that type of structure. We are considering a number of different angles, including I'm not sure if I'm including perhaps, you know, we are looking at some different approaches that would enhance the value for shareholders while providing the market with adequate liquidity. Because I think one of the biggest things affecting SCI shares is, you know, pension funds own a lot of it, and there's a reason why they own a lot of it. They are patient long-term investors. And we are building a business to stand the test of time that we think will, you know, generate substantial return to shareholders, just that the company only 5 years old, right? So I think we are not gonna use an approach that is using a drip method, because then that doesn't really add value to shareholders. It would more just provide liquidity. And the purpose of the buyback is to provide liquidity as well as to add value to shareholders, because I've said it 1,000 times, the shares are undervalued, in my opinion. And so we're gonna look to use an approach whereby the buyback achieves both of those objectives. I don't want to discuss, you know, what we are gonna bring to the SCI board on the buyback before we actually bring it. So that's why I'm being a bit coy. But that's as much additional color I can provide. And the you know, we are obviously we would have been mandated to do this, you know, 5 years after we do the IPO. Obviously, we're not 5 years before the IPO yet, but we are going to make good on that from early. Yeah.
Okay. So I have 3 more questions. So I'll just take those 3. One of them is pertaining to would SCI ever utilize the equity conversion option on its preference shares and sell those investments to another party?
I see that we have some budding investment bankers asking questions, man. Good. It depends, right? So it all depends. Again, we have a buyback that is coming around the corner. In the future, we will need to do small additional public offerings, because we're gonna want to maintain kind of that mix of between equity capital and unsecured debt and, you know, senior debt, etc., right, to get a very robust balance sheet that can navigate any financial environment. But it's something that we will absolutely consider if the timing is right and the economics is right. So for example, if we felt that one way to get equity into the firm from, let's say, external investors, without doing, you know, yeah. So the answer to the question is it's an option on the table. But I like the fact that people are thinking like that, because ultimately this is, you know, all of these discussions is really and truly not about, you know, talking about financial results per se. It's really about creating value for shareholders, and ultimately, you know, we are very clued up on that, and that's what we want to do. So you know, it's an option that we could pursue. You could see us, for example, structuring something to get additional equity by, let's say, external parties if the economics were right. So absolutely, yeah. It's an option and a possibility.
Okay. So a question that came in was pertaining to SCI had 17.19 million in loans from related parties. Is it that capital was used to act as a bridge in the absence of the preference share offer? And
No, that 17.19 million is from the subsidiary SCIJ.
Okay.
So it's subsidiaries, Jamaican subsidiary raises capital on behalf of SCI.
Okay. Okay.
Yeah.
And the last question that we would have received was pertaining to the mining asset for the mining and quarrying asset that was mentioned as a stage 3. Could you state what is the loan, what is the principal on the loan and any accrued interest?
So the full value I think was 1.39 million thereabouts. And I think the principal value is about 1.1. Don't hold me to that. I would have to get that answer specifically and tell you. But I think the outstanding value, which includes accrued interest, is about call it round off 1.4 million. But I think 1.33 million.
Okay. Okay.
But don't hold me to that. I probably have to get the exact figure on it, but it's around that because it's 2.33 million. Yeah. I'll call it 1. For simplicity, use 1.4.
Okay.
But I will have to go and check on that. Yeah.
I think one question came in pertaining to, I think it's about the risk management. In terms of general receivables, what are some of the methods that Sygnus utilizes to ensure that those receivables are collected?
Oh, good question again. Good observation. So effectively, we have a team that effectively tracks interest when it comes due, or dividends as the case may be, or principal as the case may be. We have a weekly meeting, and from that weekly meeting, calls are made every single to all of those clients. So we have actually a process, which I think was outlined in the private placement, where we notify clients or portfolio companies in advance of when those payments are coming due, like 30 days before, 15 days before, on the day of the payment, then 5 days after, 15 days after, 30 days after. After 30 days, you issue a letter. And then after that, you issue a legal letter. 45 days has passed, and then we have our, all of these past due amounts are reviewed in that weekly meeting. We also have a monthly risk management meeting that reviews not just past due amounts, but in terms of covenants. And so we have a process just like what you have at any other type of financial institution that has a robust process in place to track down and collect monies, as well as when you see problems, you because we're using a partnership approach, we look to see how best we can structure a solution to assist portfolio companies, because that's a differentiating factor between SCI and traditional financing. And I think this has worked for us. Notwithstanding the one Cayman asset, this has worked for SCI over the last 5 years, given the very low loss rate that the company has in 5 years of operation.
All right, thanks for that, Jason. And I'm not seeing any more questions right now. I'm checking and I'm not seeing any. So if there's any additional questions that may come, you can send an email. We will respond to that platform. I'd want to ask that, thank everyone for joining our call. I'd want to also encourage you to save the date. We have a Sygnus Day coming up on September 2022. At this presentation, we'll be actually having one of the world's largest asset managers speaking. That is Mr. Lodell Robbins, who is the asset manager for BlackRock, who has assets under management of over 8.5 trillion. They'll be one of the key speakers at this Sygnus Day. So save this date. You can definitely look out for it. And again, thank you, everyone. This recording will be available on the Sygnus website. So I encourage you guys to go and look at the new revamped Sygnus website, as well as the MD&A and audited financials can be found there. Thank you again, Jason, for making yourself available for this presentation. And thank you, everyone, for joining us today in this earnings call. I hope everybody stays safe and have a good rest of the week. Thank you.